Well, thanks for tuning in to our spring crop insurance update meeting. I'm Corey with KW Insurance, and I am going to walk you through all the changes for the 24 crop year, our predictions on ECO and SCO for the payment that will be coming up soon, and just in general, some stuff just as a refresher for your crop insurance for this coming crop year. So, the first thing is that we've never really pushed this livestock risk protection product before, and so this is a subsidized put that the government provides that basically allows us to put a bottom in the livestock market. And now that we're at historic highs in that market, this stuff makes a lot of sense. And so I'm going to kind of get into how this stuff functions and then how to go about getting animals put on it and then some of the rules that you need to be familiar with this program. So what is livestock risk protection? It's usually referred to as LRP, so you'll hear that as we go through this presentation. It's basically a subsidized put option. If any of you guys had marketed with puts and calls and grains, you'd be familiar with that. It's just insurance that triggers basically once the market gets below a certain level. The cool thing about using this versus a put option in the cattle market is you can do any number ahead from 1 to 25,000. If you were to do them on the open market, you'd have to do 50,000 pound lots, and so 80 to 100 head of calves that have to go on here all at once, right? This we can pick any number from 1 to 25,000. So we can hit the number right on the head for what you have for cattle. You don't have to price them all at once if you don't want. And then it provides downside coverage with unlimited upside. So that's probably the most appealing part for the livestock guys. How does it work? Each day as the market closes, quotes are released each day after 3 p.m. So when that feeder cattle futures closes, right after that, they would release the prices for this product and the trigger levels that we could pick. We're limited to the trigger levels that were actually traded on the board, and so that's why some days there might be 10 options and some days maybe less. But anyways, I think that'll make more sense when we get into the quote part. You pick the time frame you want to market the cattle in. We've been really suggesting people have this insurance end on the same day that their pricing risk comes out of the cattle. So if you video sale in July, that's when you'd want this insurance to end, even if you don't deliver those cattle till October, because at that point you've locked in your price on your calves anyways, right? So choose a percentage of the futures market you want to insure. Just like crop insurance, the higher level we go on this thing, the more expensive it will be. And then your premium is due the first of the month after your coverage ends. So in that last example, if your coverage ended in July, your premium would be due August 1st. There's a few rules we need to keep track of in here. You can't sell the cattle more than 60 days prior to the end of the coverage period. So in that last example, if our coverage ended in July, we could not sell those cattle more than 60 days prior to that date, or we would still pay the premium on this product but have no coverage. So that's really the only stipulation on what you can do with the cattle is you can't sell way early below the end date. You don't have to sell the cattle by the end date. So let's say that we video sale those cattle in July, or we were going to. We had the insurance set up to end in July, but you decide not to do that. You decide to wait until the fall to actually market those calves. That's fine. As long as you have ownership of the right number of animals when this product ends, that's all that we really care about, or within 60 days of when it ends. If you have deceased livestock, we need to know about that within 72 hours. If we get a report of your lost calves that you had, let's say, or whatever, those would carry on that insurance all the way till the end and then would trigger a payment if there was a payment issued. If you don't report the death loss within 72 hours, you'll pay the premium on those head, but you'll end up not having coverage at the end because we won't have the right number of animals to satisfy the insurance. So you pay premium on something that there was no loss possibly triggered on. What we've done with guys is had them put in a death loss cushion in there, like if we're pricing the unborn cows and calves part, so maybe only insure 90 to 95% of what you have for cattle, not 100%. And then there's that 10% cushion where you could have death loss and we'd still have the right number of animals. So the first thing that we can do, which is the most common right now, is we can do unborn steers and heifers, unborn calves and the cows. You can price calves that weren't born yet. The cool thing about this is even though we haven't started calving, we can lock this market in and put a bottom on it. You need to pick an end date when you think the calves will be less than 600 pounds. That's not normally a problem anyways because that's close to where our weaning weights are. But on the unborn steers and heifers, that's as heavy as we can go with 600 pounds. A great way to lock this high market in for next year's calf crop. It assumes half steers and half heifers is how this works. That's why you don't have to sex anything when they're on the unborn status. The next step you would take then, if you have calves on the ground, or if you bought some calves, we can actually split them between the steers and the heifers. The steers would get a 10% premium above the heifers in both price classes, and we can go from the 600 to 1,000 pound class. So if you want to do Heavier animals, later, let's say you're going to keep yearlings and you want to run them on grass and they're going to finish out at 950 on the grass, let's say. That 600 to 1,000 pound benchmark would be for them. Less than 600 pound range would be for most of you guys that are going to sell wean calves this fall, right? The lighter weighted calves just get a 10% bump in coverage above the heavyweights per pound or whatever, and that's to kind of make up for the fact that lighter calves are always priced higher per pound than the heavies. So you can also do fed cattle. So if you're going to retain ownership of some cattle, put them into a feedlot, we can actually price them off the fed cattle futures instead of the live cattle futures, and they'd be the 1,000 to 1,600 pound weight range. So just real quick example on how this works. If it's February 15th and you have 100 head of bred cows and you'd like to lock in a bottom on your calf price using LRP. So you normally would sell your calves July 15th on the video sale, and we're going to say at this point they would get to 600 pounds by then. 5% death loss is what you expect during calving, so we don't want to price all 100 head. Let's say out of those 100 bred cows we expect to have 95. We might as well just go ahead and do 95 head. We could always add a couple more head on later if you guys wanted to increase your numbers, but it's much easier to just insure what you realistically think you're going to have for cattle. And then on July 11th, that's when this insurance would then be set up to trigger. There's basically one trigger period per month that we can pick on this. So your sale might be July 15th in this example, but the insurance can only trigger in this example, July 11th. So that's as close as we could get to when our pricing risk is gone in these cattle. So we pick July 11th for the close date for the insurance. That's 21 weeks out from February 15th. And then you have a quote that looks like this. So if you look at where my pointer's at on the screen, you can see we picked this line in this quote. So we're down here, our expected value is $2.75 a pound off the futures market here. This would cover us in once it gets below 265. So once the market drops 3%, this would start to pay below what our trigger level is. And then our premium over here is $6.53 per hundredweight, or in this scenario, it'd be about $36 a head. That has been the most popular coverage level for what people have picked, at least through our agency, is kind of in the middle here somewhere. So that keeps you close enough that the market only needs to drop about 5% from where we locked it in to really get your money back. But you're not paying the high premium like the $8 a hundred up on the top up in here. So how's the loss payment work? So here's a loss example. The cattle market drops to $1.75 per hundredweight or $1.75 per pound on 9/25, which is in this example what we set for our end date. So on August 25th, that's September. On September 25th, the futures closed at $1.75 for that feeder cattle futures that we priced these on. Our coverage was set at a bottom of $2.47. So we would take then our coverage level of 247, where the market closed at, which was months out from when we purchased this, right? So the market tanked, it went back to $1.75, which this is a realistic example. Our moving average in that market is probably $1.50 to $1.75. So this seriously could happen. Anyways, that gives us a 72 cent per 100 pounds loss, or 72 cents a pound on these cattle. We insured 95 head at 600 pounds, or 57,000 pounds of calves. The 57,000 pounds times the 72 cents that it's below our trigger level gives us a $41,000 loss for $3,900 here. So as you can see, this could pay out quite a lot of money when the cattle market finally corrects here. And it's going to either happen this year or next, but I will get into why I think this will definitely happen and why this is a good value at the moment. Anyways, so loss rules, you must submit a loss within 60 days of the end of coverage. That will kind of take care of itself, because within NAU system, when this triggers a loss, it'll just generate a notice of loss for us, and we'll just have to have you sign it. So we'll tell you if there's a loss. That part we'll take care of. You have to prove you had the cattle. This usually can be done off of sales records if you took these to the sale barn in October and this triggered in October. If it's a scenario where you video sale them in July but they don't get delivered till October, then we need to somehow prove the number of head of cattle that you have on your place even though they weren't sold. And that would be off of vet records, a statement from your feed salesman. We just need something to verify the number of head of cattle that you have so that they can prove you're not using this for speculating, basically. And why is now the time to do this LRP insurance? So this is a all-time historical feeder cattle futures market chart. And if you look, back in 2014, we had a big run-up like this and a big correction. we are now in that same pattern, right? So we are in that where we kind of peaked, we had a correction, and we're on the way back up now. One thing with commodity markets, and it doesn't matter if it's corn or wheat or cattle, none of this ever stays stagnant at a high here. So this cattle market is either going to run some more up or it's going to correct way down, but it's not just going to sit here. That's one thing that I'm quite confident in. And if we happen to catch a recession, a mad cow thing comes along, the demand for beef falls out, we could actually have this drop easily back down to that $1.75 example we had in that slide. So right now, for $6 a hundredweight, we can put a bottom on this cattle market at what was historically the highest point that had been before this last run. So it is, in my mind at least, a no-brainer to lock this in where it's at. How often can you lock in profits on the cattle market, basically? So how to get started? Contact us. You set up an LRP policy. That just means that you get a policy active in the background. That allows us to clear all the government edits with your tax ID numbers and all that stuff. That just then leaves us with an active policy that we can start endorsing cattle on. It doesn't commit you to insuring cattle. So there's no reason, if you're sure you want to do it through our agency anyways, that you wouldn't call and get this set up. Have that active in the background. If you never use it, it won't cost anything. But once you decide then that you want to start putting cattle on, that allows us to do it that day. Once you decide to price the cattle, we need to know between 3 o'clock and 5 o'clock p.m. that day. When we talk to you and we set your app up, we'll have it start emailing you quotes automatically every day. And so when you get to a day where that is to the level that you want it to be put on, just let us know. We'll add those cattle. We'll send you an e-sign app. You'll sign that, and then you'll have them insured. So I really am confident that now is a really good time to look at doing that program. And I think once the cattle market stagnates back down at that normal, it's bouncing between $1.50 and $1.70, maybe that LRP doesn't make as much sense. But right now, where you could have shifts of 20 to 30 cents at a minimum back and forth in the cattle market, I think that now is the time to be doing that insurance. So real quick, like if you're an NAU Country customer, which most of you guys that are with us are, you can set up a farmer portal. So if you go to naUcountry.com, you log into their site and or create a login for their site. As part of that, it's going to have you put your policy numbers in. Once you do that, you can go in there and see if you have multiple policies, each policy and what you owe. You can also see stuff like your APH reports if you want. Your schedules of insurance would show up in there. And then you can go to this Field Insights tab, and it'll show you all kinds of stuff just for free on your farm, linked to each field on your farm that's just provided for free as part of being an NAU customer. So real big fans of the farmer portal. If you were at our in-person meeting, then you would have got this full farm quote. If you haven't received this and you're watching this video, let us know and we'll email it to you. But that'll just have each crop on your farm quoted, what your coverage per acre is and what the premium would be, and then what the ECO and SEO will cost too. So I'll skip through that part. What are we looking at for next year for coverage? When I had done these slides, barley was still up some, or I didn't understand that malt contracts had dropped off as much as they had. So what I have here is a comparison of a 730 malt contract for this crop year versus 775 for last year. It's probably more like $6 versus 775 now. But regardless, you can see your premium is going to be down a bit on barley, mostly because the coverage is down and nothing really changed in the rating on the barley end of things. So a $7 malt contract, this is in a 36 bushel average barley field, will give you about a $200 an acre guarantee now. If you add stack SEO and ECO on top of that, about $250. You're paying about 8% of your total coverage if you do ECO, SEO, and this all together. So actually about what you used to pay just for optional units. If we get you into enterprise and ECO and SEO, we can provide the same amount of coverage. Spring wheat 24 versus 23. Big thing here is that the price dropped a bunch from last year, so you're looking at a drop of about 20% or more in your premium. Last year's premium on this example would have been $15.77 for that coverage. This would get you down to $11.28. So a drop in the spring wheat premium. If you guys are big wheat guys, you can probably drop that budget about 30% from what it was the year before for similar products, but your coverage went down the same. The small Kabulis, similar to last year, I put 30 cents on there. They actually now have averaged out at 28 cents for the final prices on those. So pretty close. Lentils, I had 35 cents on this quote. They came in at 37 cents. Now that the prices have been released, we didn't have that when I had built this presentation. So lentils are the big winner here for guarantee. You can see this is map area 2 in Toole County, 966 pound yield to get you a $250 an acre guarantee. In contrast that with maybe recrop wheat on that same unit's probably going to be less than $100 an acre for the guarantee. So the pulse crops are the one shining star in here that has a market that's still up, and those look to be something that can provide some pretty high guarantees for you guys still. Durum is 803 a bushel in 24. It was 1011 in 23. So you're not going to get, I know some of you guys had $10 durum contracts. The crop insurance just bases this off of the futures market times about 115 with about 15% premium on top of the spring wheat futures. So in that case, we're only getting $8 a bushel for durum if you have a loss in the crop insurance, not the 10, but it's still going to be way better than the $6 and some odd cents that spring wheat's priced at. So durum's a pretty attractive crop to look at if you're looking at this just from a crop insurance guarantee standpoint versus the spring crops. So here we have our standard checklist. We'll go through this with you on the phone if obviously you weren't at our meeting if you're watching this probably, but it's really important to catch things like if you're doing new breaking right now, because we only have till March 15th to get that insured, or if you're going to try and insure a crop that isn't insurable normally through the crop insurance, this deadline is approaching quickly on all those sorts of things. So big thing is, tell us if you're doing new breaking, if you added anybody to your entity, if you're going to do anything weird like a crop that we can't insure in the county, just let us know about that. So 2024 year in review, another year of drought in the high line. We had $12.5 million of losses this year versus $17 million last year at the same point as this presentation was created. So similar levels of losses, but not quite as bad as 21. Very likely more SEO and ECO to come in April for most all of you guys that are watching this if you're on the high line. So I'll go through that. Enterprise units is now available on flax and mustard. That's a huge change because that'll drop your mustard and flax premiums down to about a third of what they were, which is great news because those crops were expensive to insure for not a lot of coverage. And the volatility factors are down on wheat especially. We were at like 0.32 for winter wheat last year, and now we're like 0.15 to 0.18 on the wheat crops. The higher that volatility factor is, the more you pay per dollar of coverage on your crop insurance. So that's good news there too. Bad news, prices are down substantially. So for snowpack issues, you guys that have potential prevent plant coming on irrigated ground because there's not going to be enough water, the RMA now considers the previous year's allotment to be your new normal. So if some of you guys only had 6 inches of rain or 5 inches of moisture, last year given to you. If now they're saying, well, we're only going to give you 5 inches again, they would consider last year's allotment your normal allotment and potentially wouldn't pay your prevent plant. The one way around this is if water districts list low snowpack as the cause on your letter from your water district, then that has a lot better chance of getting pushed through on these prevent plant claims. So make sure you contact your agent and let them know what's going on, and that we could kind of maybe pressure your water district to make sure they have the right wording in these letters too, to give you the best chance of getting PP payments on this stuff that's short water. So another thing is organic buffer zones are required on all these organic claims. They're starting to enforce that a lot stricter through the RMA now. So make sure on your maps that you draw in buffer zones anywhere that you border conventional stuff before you report that stuff at the FSA. They were everybody was kind of lax on this in the past, and now that's something that just absolutely has to be done. So if you're an organic guy, make sure you do that. The other thing is good farming practice stuff is starting to come more to light in organic. So make sure you are seeding according to what your organic plan says. If you need to work the ground to control weeds before you go seed it, make sure you do that kind of stuff, because these claims might get a little bit harder to get paid out if we're doing things that aren't right by the book. So this leads into this is the importance of reporting all the shareholders in your entity, and this is a huge deal anymore. The RMA released a final rule on this matter in 2022. It said basically if you fail to report all persons with more than 10% interest in your entity on your policy, all the crops included on that application for all applicable crop years will be void. So if you brought your son or daughter in and now they've got 25% share in your corporation where they had 0 and you forgot to tell us, we get to claims time and that then gets triggered or caught. Basically, you would have avoid policy for that crop year. We definitely don't want that to happen. So make sure you report. So this chart is the inflation adjusted wheat price all the way back to the 70s basically in here. And as you can see, we've been in some tough wheat markets before. What this is showing is what realistically a bushel of wheat will buy compared to a bushel of wheat, let's say back in 1970 or whatever. And you can see there was some pretty good times back in the early 80s before we hit that recession and interest cranked up and things kind of fell apart. We are in a similar scenario now where we're hitting higher interest rates, a potential for a recession coming. But the take of this slide is where my pointer is at on here. That was back in December before we lost almost another buck off of this wheat market, or 80 cents or whatever here. So we are close to what is the historic lowest price for wheat when you take inflation into account in the history of this chart anyways that we have. So it just sort of highlights the importance of looking at other crops, I think, and possibly why wheat's going to be so hard to cash flow. And also just maybe we start tightening our belts a little bit, because things are going to be pretty tough if this doesn't correct here for the next couple of years. Conventional prices for 24. So this shows you winter wheat was set at 738. That's before the market kind of collapsed some here. Spring wheat's at 687. So actually 50 cents below winter wheat. Durham's at 793. I think in my previous slide I had it at 808 or something, but this is where this pretty much shook out at. So pretty close to $8 for Durham. That's the one at least kind of bright spot in there. Canola's only 20 cents a pound. That gets us back to about 10 bucks a bushel on that crop, 339 on oats, and 436 on barley. So major winding backwards of these prices from the previous year. The good news is that cheapens your premium up a bunch. It just makes it harder. If you're using like insurance for getting operating, this is going to drop those guarantees quite a bit, which makes the ECO and SEO even more important, I think. So on organic, you basically just take all those prices and double them. The one thing on organic is if you do organic canola but you don't get a contract, you are stuck at the conventional base price for that crop. So it's very important if you're going to do organic canola to get an organic contract for that crop. The one thing with all of these prices on the organic that you're seeing here, you can usually use a contract to increase that price. Make sure that the CP option is elected on your app. So if you look at all your crops, if you're organic, it better say CP next to all of those crops. If that's the case, then we can add your contract on top of these prices if you can get a commodity contract to increase them. Pulse crop base prices, these are actually now set. So sorry, I should have changed this slide, but anyways, the green and yellow peas, 15 cents, that would be correct. The small Kabuli chickpeas ended up at 28, the larges at 30, and then the lentils were the shining star in here, 37 cents a pound for lentils. So really good guarantee for the lentil crop. Anyways, if you guys are with us or with the NAU, you get a schedule of insurance that looks like this. The most important thing, make sure your crop insurance is correct, is that we don't screw the acreage reporting up. And the easiest way to do that is first to look at the cover of the schedule. All of these crops are color coded by where they're seeded. Make sure that looks correct to you guys. When you go in the inside cover of this, you're going to see all your acres summarized down into type. Most of you at least would know your dry peas compared to your lentils. Let's say your dry peas maybe you had 1,000 acres of, and your lentils you had 500. Make sure these numbers all look correct by type. And then if you get to the inside pages of these schedules, if you want to get more into the weeds, this will actually show you your guarantee per field if you look down on those lines, which is helpful when you're harvesting to determine if you have a loss or not on that individual field. And the biggest thing is in the back page of your schedule, there's a summary sheet. So if you find last year's schedule of insurance, it's going to show you, in this example, this is our barley, this top line. We've got a premium guarantee of $149,000. That's just for our individual farm. But then the county-based stuff like the ECO and the SEO, those are listed below that. So you would go to the premium liability column and then add up the ECO and SEO lines. If that truck, then that would be your guarantee if that crop triggered completely in the counties for those programs. Then your premium too is listed over on the right-hand side by crop that you can check out. Beginning farmer rancher, this is a real big deal if you're bringing kids back to the farmer ranch. They get a pretty sizable discount for the first 5 years that they start farming. We can exclude any year that they were under 18 or in active duty in the military. That's kind of a big deal sometimes, because if you guys, especially if you have farm and ranch, sometimes your kids might have had 2 or 3 head of calves or something they were selling a year through the sale ring in their own name. We can exclude those sorts of sales as long as they were in college in the military or still under the age of 18. Once we get past that date, those couple head of steers would start taking away from their 5 years of farm experience. So it's pretty important to kind of watch. Don't do a little bits of revenue to a kid if you want them to come back and farm big time. The other thing is, don't include a young person on your own corporate entity and just merge them into the farm that way. If you do that, they won't get any of this beginning farmer rancher benefit stuff because you guys as shareholders in that corporation have already used it up. So it's always better to have, if you have a young kid come back to start, make sure that you start their own entity for them and let them kind of farm on their own to get as big of a benefit out of this program as possible. That also helps with the FSA because there's a lot of beginning farmer apps or bennies there too. So you need to fill out a beginning farmer rancher app before the sales closing deadline. That'll be March 15th for all these spring crops. So make sure you talk to your agent if you qualify for that. You get an additional 10 points of premium subsidy. I always give this example, but enterprise units, you've got an 80% premium subsidy on for the most part. This would move you to 90% subsidy, so it would cut your premium in half in an enterprise unit scenario for a beginning. So native sod breaking, that's another big deal, not only through us, but through the FSA. And the take home from this is do not do anything with anything that says sod on your maps or that you suspect has even possibly never been farmed before without talking to the FSA and us. Through us, it's not insurable the first year without a written agreement. That'd have to be done by March 15th here. Then the next 4 years after that, you're only going to get 65% of the county average. And they're going to take your premium subsidy and reduce it by 50 points on the crop insurance side. For the first 4 years, you see an insurable crop on that. So if you're going to do a bunch of native sod busting, it could be very expensive on the crop insurance side without much coverage. At the FSA side, it actually, if you don't do this correctly and have a plan for breaking it out done before you do it, it could disqualify you from basically all the government subsidy stuff. So very important to address native sod through the FSA before you break it. On CRP breaking, important rule to remember here is you get 2 years from that coming out of the CRP program to get it seeded with 100% of the county average and without having to do a written agreement. So in this example, we're going to say the CRP came out in the fall of 2019. That's actually the start of the 2020 crop year. So just think if I seeded something in the fall of 19, what crop year would that be for? Like winter wheat in fall of 19 would be for the 2020 crop year, right? So we would have the 2020 crop year, which is when that program came out, all the way to the end of the 21 crop year to get that seeded. So we'd have all the way till the spring of 21. If you get to the fall of 21, that now starts the next crop year, right? Just like had we seeded winter wheat there. So make sure you seed it within 2 years of coming out of the program, or you'll have to do a written agreement. It'll be considered new breaking, and you'll probably only get 60 to 80% of the county average, 65 to 80%. The other thing that happens with this is sometimes you might have an absentee landowner or something that had the CRP ground. They look to lease it out, or you might call them and they'll say, oh yeah, I'll lease that out to you guys. They assume that it came out of the program, let's say 2 years ago, when in reality it really has been out of CRP for 6 or 7 years. That happens every year through our agency that doesn't get caught by someone. So if you're going to lease some ground, make sure you go to the FSA and verify when all of those pieces of CRP came out that person's trying to lease you, because it's possible it's past this 2-year break and we'd have to do a written agreement. CRP out after 2 crop years. After 2 years, it becomes new breaking, and it's just like an old hayfield or something. We need to do a written agreement to get it insured, and you're either going to get 65 or 80% of the county average, depending on what soil type that land falls in. Written agreements must be done before September 30th for the winter wheat or March 15th for the spring crops. So make sure that you talk to your agent ASAP if you're going to do that. Or if you have any new breaking, it might be hayfields that have come out after some time or something. The other thing is when you do new breaking, then this doesn't qualify. CRP, when it comes out, you can basically spray it out and seed right into it. If it's considered new breaking, it has to be sprayed out or worked prior to June 15th to be insurable as a fall crop. So if you're going to seed winter wheat into a hayfield that you're breaking out, we need to have that sprayed out by June 15th before we seed it back to winter wheat that fall. So make sure you remember those dates, or that winter wheat might not be insurable. Added land, basically, if you keep it under 2,000 acres, we can use the better of the simple average of your own yields for that new land or the county average. If you get over 2,000 acres, we're limited to the county average. So that can be a pretty big deal if some of you guys have sizable yields built up that you want to use for the new land. Make sure you check with us on that. On the 2023 SCO payments, the yields for SCO for the 23 crop year will be released at the end of March, first part of April usually. The payments then will be issued in the middle of April is usually how this works. So it's really likely to pay along the high line on most crops this year because we hit bad enough droughts and the market's dropped that there's a market drop on the wheat and barley market 15 to 20%, which means that we could have cut pretty much an average crop even in these counties and got paid because the market dropped so severely. So market drops help us a lot on these payments anyways. And I'll get into the more of the predictions and why I think those are going to pay as we go forward. On PLC for 23, that's an FSA program, right? The average national average wheat price looks like it's going to shake out around $7 a bushel. That doesn't finish averaging up until the end of May, basically. So we got a couple months left in this, but it's pretty well averaged out. So no payments triggered on PLC this year. But I think because the wheat market is down so low now that it will start to trigger payments next year if something doesn't correct. So there's another good reason to be in PLC with SCO stacked is that you can get a PLC payment plus get an SCO payment if you're in that scenario. If you switch to ARC, as these prices drop, it makes ARC a little more likely to pay. That is true, but then you can't be an SCO and you're stuck just with that ARC payment for your county-based part of stuff in there. So what about the ERP program for the 23 crop year? There's some things working in our favor here as far as getting the government to issue some disaster stuff. And one of those is that the U.S. farm income, as this thing says here on the slide, this is an article I found, U.S. farm income set for biggest plunge in 18 years as prices cool off. So when we get stuff like that where the markets are drugged down enough that it's going to make the ag economy tough to function, that is certainly makes it more likely for another one of these programs to be issued in 23. The USDA also was issuing $306 million in final ERP Phase 1 payments. You guys probably got those already. That was that additional 3% top-up that would have been deposited in your account for the 21 crop year stuff. So that program just closed out. It looks like they're probably just going to push the farm bill out another year until we get past the election unless some miracle happens here. So if that's the case, then yes, I think there's a pretty good chance there'll be an ERP program for last year's losses once again. One thing that came to light, though, in the 22 ERP is that disadvantaged farmer status is a big deal. So if you can set your entity up so you and your spouse are 50-50, that's a big deal in these programs to have a 50% female-owned entity. 50% is the trigger level of that. So if you're a spousal entity, we had one guy where he just didn't have his wife's name on the leases. It was just him. And so it was just him at the FSA and not him and his wife together. Just by changing some of those things so that you're a 50-50 female-owned entity, it could trigger a lot bigger payments on this. For example, on our own farm, it took our payment from about what would have been about $10,000, I think, for the 22 ERP up to something like $50,000 because Wendy actually does all the farming, so she really is a disadvantaged farmer. Anyways, it allowed us to get all of our premium back for the 22 crop year, where if you weren't a disadvantaged farmer, you don't get that back. So long story short, it's worth looking into your entity structure and making sure if it's possible to do it, that you could get yourself into this disadvantaged farmer status, because that seems to just be a big deal in all these payouts anymore. The 2022 ERP payments were severely factored due to limited budget, so most of you had what you had in your head for a payment was factored way back because there wasn't enough money to pay out to everybody. So another reason to look at the disadvantaged farmer status, because it changes some of that too. How are we looking as far as moisture this year? Actually, as far as the drought map goes, we're in a little better shape. So we're actually in an abnormally dry. Last year we were in a D2 drought at this point. I think there's a little more severe drought than this map shows, and that's a good reason to go onto that drought reporting site and tell them about the conditions in your location. So if we get into this spring and it's looking like things are drier than we were expecting, start sending that off to that drought monitor. It really makes a difference in getting this changed. And once this bumps above a D2, that triggers a lot more payments to help us out when we're in these horrible dry years as far as cycles go here. So we added safflower to our rotation sheet. There are some rotation restrictions on safflower. If you look at this current year's planned crop, if you look at safflower, basically just don't do it broadleaf the year before you do the safflower and you should be okay. But This crop rotation sheet is on our website. You can always find that there. And if you guys have any questions, feel free to call. Safflower insurance, there's more of that happening here. It's insurable in Liberty County and then all the way to the east in our state, and also down in Pend Oreille County, but not in Toole or Glacier. So if you're going to do safflower, that's a written agreement crop for Toole and Glacier. We need to know that real quick like here. 25 cents a pound for conventional and 31 cents for organic. That gives us a guarantee of about $127 an acre for the conventional part, and about the same for the organic at about the 70% level. So not a real high guarantee crop. We can use contracts on the organic side to up that coverage some if you guys can get those, but a cool little rotation crop. Anyways, I just wanted to make you aware that it's insurable. The earliest seeding date's April 1st. The latest is May 20th. October 31st is the end of the insurance period. So all of that kind of matches up a little bit earlier than wheat and barley, but the insurance period ends a little bit later. The max contract price we can use in the organic, 63 cents a pound. So that puts you at about $130 an acre guarantee on either one of these, organic or conventional, because you start with a lower yield on the conventional. So here's the earliest seeding dates on crops. This always becomes a deal if we have an open winter and then leading into a spring, which is kind of where we're at this year. It's April 6th on wheat and barley. That's the earliest the insurance would pay you a replant payment if something went wrong. If you seed before that date, it doesn't mean you won't have insurance going forward. It just means if it comes up and it dies out and we have to reseed it, you're going to lose that part. That's a really big deal on canola and mustard, especially canola because it's so frost susceptible. So that crop, it's best to wait till April 15th to seed. If that canola comes up and it frosts out and you seed it at April 1st, there will be no coverage on the insurance for that here. And then the peas and lentils are the earliest, which is March 25th, which we're not too far off from on that yet, right? And then flax, April 11th. On the late seeding part, the canola has the smallest window, so we have from April 15th to May 15th to get that seeded. After those dates, we start getting penalized on our coverage. The smooth peas and Austrian peas, we need to be done by May 15th as well. And then flax is the latest crop all the way out till June 10th. So enterprise versus optional units is, if there's one thing that's very important to grasp in insurance, if you don't want to pay a ridiculous amount of premium for something that you shouldn't be paying for, it's this. And so, do I qualify for enterprise units? You have to have 2 or more sections of that crop with 20 or more acres in each section to qualify. So that's the first thing. Make sure you get that part right. And then some crops don't have enterprise units. Now we're down to just basically triticale and camelina for those, I think. So since they just added some this year. So in this first example, I got 120 acres in section 1, 15 acres in section 2. Does that qualify for an enterprise unit? It does not, right? So we were 5 acres under that 20 acre mark there. My second example, I got 100 acres in the one section, 30 in the other, and then they both have more than 20 acres and 2 or more sections, so it qualifies. If you're a guy that crosses county lines and you just have one section, let's say in Pend Oreille County, we can do a multi-county enterprise unit election. This needs to be done by March 15th as well. But that election allows us to combine the Pend Oreille County section with the Toole County stuff to get you that enterprise unit discount. Enterprise units. So this is enterprise units by type. Which, as you can see, is a very exciting change that we had here in a couple crop years back. But now this allows us to keep the winter wheat separate from the spring wheat, separate from the durum. So instead of throwing all the wheat types together into one enterprise unit, which is what used to happen, we can now do that, keep these separate on the insurance. The big thing is you need to get it changed from EU to ET on these crops on your app. So make sure you look at the application you just got mailed from your agent and make sure you have ET. We can do it on wheat and we can do it on the P types. So make sure it says ET, not EU next to those. As like I said, same thing for, it'll keep the peas separate from the chickpeas, separate from the lentils. And then feed barley and malt barley still don't have this option for some reason. So those are still thrown together. So if you're going to do feed and malt together on your farm, it's not a big deal. It's just it's all going to get thrown into one pot before we can pay the claim out, basically. Same premium discount as before, but you need to make sure you seed 2 sections of at least 20 acres of each type now in this scenario. So that's where this can kind of get derailed, where guys lose track of winter versus spring wheat, let's say. So in this example, last fall we seeded section 1 to 100 acres of winter wheat and section 2 to 40 acres. So our winter wheat in that scenario qualifies for an enterprise unit. But then we go out in the spring and we seed 200 acres of spring wheat just in one more section, and don't do another 20 acres of spring wheat in another section somewhere. In that scenario, then we could either throw the winter spring wheat back together with the winter wheat, which most of us don't want, and get you the enterprise unit on the discount on the whole thing, or you're going to have to pay for the optional unit premium basically on that spring wheat unit because you didn't get the other 20 acres seeded. So make sure if you're going to do this and you want the biggest premium discount that you get 20 or more acres of each type seeded in your seeding plan there. This next one, this is how you would do it correctly. We got 100 acres of winter wheat in section 1, 40 acres in section 2, so it doesn't take a lot in another section, right? And then in the spring, we went out and seeded 2 sections of spring wheat. Those would each have their own separate enterprise units that would get paid separate on a claim in that scenario. So why is this a big deal? This is a quote from this year just on your individual coverage. It doesn't have ECO or SEO on it. If you're at the 75% level, it's $10, almost $11 an acre for optional unit premium, and it goes all the way down to $391 for enterprise. So just by seeding that extra 20 acres of that type somewhere, you can cut your premium down to a third of what it normally would have been. So how to plan seeding using these enterprise units by type so that you have the lowest amount of risk. This is just a map of our farm that they're colored in here. You can see we have our flax all on one end and the barley on another. That's one way to limit your risk, is at least keep all the same crops in the same area. But let's say down here where my pointer's at, you seeded winter wheat, and we have that in 2 sections here, so that has an enterprise unit in it. Don't go seed winter wheat then way up on the north end of your farm if you can avoid it, because that's going to throw the winter wheat together in one enterprise units on 2 very different pieces of land. It'd be better to do the winter wheat here, the spring wheat up here, and then the durum down here. And then basically we have kind of an optional unit set up on our farm, but with that giant discount with all the types splitting our farm up. So malt barley changes for 21 and beyond. The big thing is now for your feed price starting in 21 and beyond, instead of using a futures market for that price, if your barley doesn't make malt, they use what you sell the barley for, basically. So that's actually a positive thing in general because it's more reflective of what actually happened on your farm. So here's a simplified malt example. Your malt contract's $5 a bushel. Your barley doesn't make malt. And so we're going to say your feed barley was valued at $3 a bushel in this scenario. So you sold the feed barley for $3. You had a $5 malt contract. So your feed barley is worth 60% of what the malt price of what your malt contract was. So we harvested 10,000 bushels of barley. For your claim, they're only going to count 60% of the 10,000 bushels because that's the amount of value we got out of the feed. So only 6,000 bushels counted for a claim. Most of you guys understand that the less bushels they count against you in a claim, the more money you're going to get. And so that's a simplified version of how the malt example works. I'm going to get into a more complicated comparison now of why you want to be in revenue protection with the malt endorsement versus yield protection with the contract pricing. And there's a lot of agencies around here that still put people, if you're doing a malt barley contract, they'll put you in yield protection with contract pricing. I am so adverse to that. I will show you on our farm why, even on our farm this year, this makes a huge financial difference. And so if you go to your agent and they tell you the malt endorsement doesn't work, don't listen to them. Call us or something, and I will explain why it still works way better than being in this other setup. So in this example, this is our own farm. So I use real bushels off of our farm, just rounded them to make the claim easier here to figure for you guys. But we had 35,000 bushels of barley we harvested. It was dry this year, so only 11,500 went malt and 23,000 went feed out of those 35,000 bushels. The feed barley got sold on average for $4.55 a bushel. The malt contract was $7.62, or the average of our malt contracts. So our malt price on our insurance was $7.62 a bushel. The other cool thing about being in revenue protection versus yield protection, which you have to be in revenue protection to be with the malt endorsement stuff here, is that we get to also get that revenue price drop when they figure the difference between what happened with the wheat market in the spring versus the fall. We get to take that off of our barley contract price for the insurance too. So this year wheat dropped a bunch. So it dropped $1.62 a bushel from beginning in the base price in the spring till the harvest price at the end. So on our claim now, even though our guarantee is based off of this $7.62 a bushel, they're only going to value all the barley, even the stuff we delivered, at $6 a bushel. So right there, they're going to value that grain at less. That ups our claim payment, which I'll get into here. So the feed sales price versus the malt price, the malt harvest price was $4.55 a bushel, which we sold the feed for, divided into the $6 a bushel harvest price for our malt barley means we got 75% of our malt harvest price compared to the feed price in this scenario. So the 23,000 bushels that we harvested that went feed, they're only going to count 75% of those bushels with the malt endorsement here, so 17,000 bushels counted for the claim. If you were in yield protection, they would have counted all 23,000 bushels against you in that claim. So just real quick, like this is the back page of our schedule. It shows our guarantee for barley on our farms, $344,000. So that $344,000 guarantee, that would be the same whether you're in yield or revenue protection. That's based off of the base price, which is the same for both of these programs. But what changes a lot is the 11,500 bushels that went malt for us is now valued at $6 a bushel instead of $7.62, which is what it would be valued at in yield protection. So in comparison, our 11,500 bushels that malted, they're only going to value at $69,000 for us. If you were in yield protection, you wouldn't get that harvest price drop. They would value $87,630 for your claim in yield protection. So right up front here, just by being in revenue versus yield protection, we get $18,000 more in this claim on our farm. 23,000 bushels went feed. So this then, if you have bushels that go feed, if you're in yield protection with contract pricing, they don't care. They're just going to value that the same. So the 23,000 bushels in yield protection is taken times $7.62 a bushel, or is valued at $175,000 basically. Because we're in revenue protection with the malt endorsement, we get the 23,000 bushels reduced to 75% of that many bushels. So for our claim, they're only going to take 17,425 bushels versus 23,000. They're going to only take that times $6 a bushel instead of $7.62, which is what would have happened in yield protection. So $104,000 in value for this claim in revenue protection with the malt endorsement versus $175,000 in yield protection means now, because this, just figuring this 23,000 bushels of feed barley, we have a $70,000 claim difference there as well. So how's your yield protection claim calculated? You take that $344,000 guarantee minus the $87,000 of malt value minus the $175,000 of feed value. So an $81,000 claim in yield protection is what would have happened to us this year. On the malt endorsement, same calculations, but we're subtracting way less value that they used for our claim out of this thing. So we end up with an $89,000 difference on our farm on about 1,800 acres of barley, I think is what we had last year, for a $2,700 premium difference on 1,800 acres. So if your agent had put you in yield protection versus revenue protection in this exact scenario we had on our farm this year, it would have cost $2,700 more in premium, and it would have made you, on the revenue protection side with the malt endorsement, $89,000 more in a claim. So never, ever, ever should you be in yield protection on anything, which I will harp on till the end of my days here. If anybody wants to argue with me on that, you can feel free to call. So flax and hemp added in 2020. So that was good news. We actually added these crops in most of our counties up here. The big thing to note on this is, if, let's say they had flax in Toole County here, and you'd seeded flax in the past, but we have no history of it because it wasn't insurable. Now that flax is insurable, we need to go back and rebuild your history of that flax. And we have till April 29th to get that done. So if these are crops that you guys have grown in the past that are now insurable that you want covered, we need to make sure we rebuild all your old history backward on those crops, or you'll start with a way lower starting yield. Triticale growing for grain was added in all these counties. So Toole and Liberty, Pend Oreille, and I think Choteau County down there, it looks like. It's not insurable in Glacier yet, and it's not insurable in Hill. And that would normally be done through a written agreement, but because this is a trial crop, they're not allowing us to do written agreements on this yet. So if you're in these counties, we can do it. If you're not, we can't right now, unfortunately. The base price for that crop got set at $5.57 this year. I think it was closer to $8 last year, so slightly lower for 24. You can use a contract price to increase the coverage on your insurance, so that's good news on this crop. There's no revenue protection on it. There's no SEO available for this crop, But the biggest thing is, if you're comparing this to last year, if you did triticale, is the county averages dropped a whole bunch. So Toole County map area 3 on recrop triticale went from a 43 bushel average to a 26. Basically take any average that you guys have up in these highline counties and nearly cut it in half, or at least down to 60% of where it was the previous year. And that's what your guarantee is going to be based off of this year. So long story short, if you're going to do this crop this year, and it's something you've been doing in the past, so you were kind of accustomed to where the yields are, they are way lower for this next crop year. So just take note of that. Flax was new in 2020. We can do that in pretty much all the highline counties. It now has enterprise units, so that's a big plus. So we get a lot bigger discount on flax than we used to if we can do that together in an enterprise unit. There's no revenue protection on that crop, so that makes it a little bit harder to trigger losses on. No rotation restrictions, so you can seed it on anything. The earliest planting date is April 11th. The latest is June 10th, so the latest planting date of any crop that we insure. Your conventional base price this year is $13.80 a bushel. It was $17 last year, so that crop also was dropped in value. Organic flax was a big deal because it had a lot of value and kind of decent yields in some of these counties. It was $40.30 a bushel in 23. Now we're down to $32 a bushel for organic flax. So not quite as high a guarantees even on the organic side for this crop. The other thing to understand in some of these weird crops is that SEO is based off the whole state's yields instead of just like your county for flax. So it makes it a little hard to predict if SEO is going to trigger. It's triggered on our farm when it should so far, because when we've hit droughts or had bad flax crops, the rest of the state had some subpar crops. And I think there's a good chance flax is going to trigger again this year. But just understand, there's a chance that SEO or ECO on crops like flax may not trigger when your county has a disaster because it's based off of the whole state. Or it could work the other way around. You might have a good crop in your county. The rest of the state drags those yields down, and you could get paid on that even if the county has a decent yield. But I just wanted to make sure you understood how that worked. On hemp insurance, you have to have 1 year experience growing it. You have to have a license to grow it. And if it's over 0.3% THC content, that's not an insurable cause of loss, so that's all on you. So high risk crop to grow, even using the insurance. We do have a guy now that has at least 1 year of experience growing it, so maybe we'll get to learn more about how this insurance works. But long story short is you can insure it. You have to have experience growing it, at least 1 year. You have to have a license to grow it, and it can't get over that 0.3% THC content. Last time I quoted this was about $150 an acre guarantee for the grain in Toole County and $750 for the oil seed stuff. It's also not insurable if you seed it basically where there was a broadleaf crop the year before, so just be aware of that as far as the crop restrictions go. And they won't insure loss of production due to the THC thing, failure to follow requirements in the processor contract, harvested production, so it's already been harvested and then it gets infected with mold, yeast, or fungus. That's not insurable. And then the inability to market due to quarantine, boycott, or processor contract default, which is another thing that happened with this crop at the beginning, right? Is we had some processor defaults. That's not a thing. They're not going to pay you just because you can't deliver it somewhere. So awesome crop, I think, for what it possibly could do here. Just understand on the insurance end how there is some gray areas in there. So on camelina, you must have a contract to insure this crop. It's just like mustard. So without a contract, we can't insure it, period. At the 65% level, that's the highest that we can go. There's no SEO available or no enterprise units on that. So you're only looking at about a $90 to $100 guarantee on this crop, even at a high contract level. So not a great crop as far as insurance goes, but it might be relatively cheap to seed. So if you're going to use it as a rotation crop, just make sure you understand that we have to have a priced contract for that crop to insure it. Mustard, brown, and yellow types are insurable in most counties, not in Glacier County yet without a written agreement. The Oriental type, though, so this is a big deal this year. There's not many yellow or brown mustard contracts left available around here. There's still are Orientals, it sounds like. If you're going to do Oriental mustard, that's a type that has to be done on a written agreement, and we must have that done by March 15th. So if you're looking at Oriental mustard contracts and you want to insure it, make sure that you get a written agreement done with us before March 15th on that. Same rotation restrictions as canola. Enterprise units were added in 24, so there's a big plus. That might take your mustard premium from $15 an acre down to $6, let's say. So big deal. there. On insurance canola, lots of canola contracts being done too now that wheat's kind of tanked. April 15th is the biggest thing. That's the earliest seeding date. If you're ever going to have a likely claim on early canola, it's that it comes up and it freezes and it'll kill that off because the growing point's above the ground. So make sure you wait to the proper seeding date on the insurance. Then remember, you have to have it seeded by May 15th or you're going to start getting penalized on your coverage. This is just was canola quotes comparing all the areas. Basically, canola, instead of coming out closer to $300 an acre this year, is going to be from 160 to about 200, somewhere in the guarantee part for most of the dry land yields around here. On peas and lentils, just remember on quality adjustments for peas and lentils, if they go number 2 or less, they'll take what they're giving you for the reduced grade, divide that into what you should have got for being number 1s, and then reduce your production by that much to pay you a higher claim amount. So let's say in this scenario, your lentils a grade US number 3, so they'll pay you 15 cents a pound for them. You have 10,000 bushels of lentils. The number 1s were worth 25 cents at the elevator. So they'll just divide the number 3 price into the number 1 price, which is 60% of the price you would have got if they were number 1s. And just kind of like the malt endorsement, they'll reduce that production from 10,000 bushels down to 6,000 bushels for your production account, which huge increase in your claim payment potentially. So the take home from this is, if you harvest peas and lentils and bin them, make sure the adjuster comes out, takes samples out of all of those bins and sends those off to the state, because we only have 60 days from harvest to get these quality samples turned in. If we get past that, then you go to haul those peas or lentils in January, let's say, and they go sample grade at the elevator. Well, there's nothing we can do about it at that point. So if they're hauled right to the elevator, they'll do samples there. We can use that for your quality adjustment. If you're going to bin these things, even if you have a good crop, make sure you have the adjuster come take samples and send them off to the state grain lab so that we have proof of the grades of this grain before we get past the 60 days. Because it very well could get you from what you think is an above average crop down into a loss if we have that scenario. So chickpea specific rules, only Ascochyta resistant varieties are insurable. All the varieties around here are that, I think. Seed must be treated with recommended fungicides to prevent Ascochyta blight and seed-borne disease. This is the biggest thing on this, is that if you don't use a product on the seed on chickpeas that's labeled for Ascochyta, then the crop comes up, you get Ascochyta, and that's your cause of loss, then that's not an insurable cause of loss. So there's a lot of risk in seeding untreated chickpeas or chickpeas that aren't treated with something that's labeled for Ascochyta on the label. There is nothing in organic that actually has an Ascochyta control label for it. So if you're going to do organic chickpeas, you'll probably be fine if you don't get Ascochyta. But if we have a wet year and those chickpeas have a loss because of the Ascochyta, not because of drought or hail or something, then that would be an excluded claim thing on your insurance. So there's also a lot of us conventional guys that aren't treating, we don't treat our chickpeas anymore. We accept this as a thing, but if our crop were to come up and get Ascochyta, we couldn't control it, and that was a cause of loss, then we would be out of luck. So if you're not going to treat chickpeas, make sure that you understand how this rule works and that you don't do the whole farm, right? There was a lot of information going around that there was a slide being presented at a chemical meeting saying you had to treat peas and lentils as well, or that all pulse stripes had to be treated on the insurance, or if they had a disease, that would be an excluded cause of loss. That we got clarification from the RMA on. That is not the case. The only thing you have to treat is chickpeas. So if you guys heard that at a meeting, disregard that. It's only the chickpeas that have that rule. On cover crop guidelines, the biggest thing is it needs to be terminated 35 days prior to planting a fall crop. So if you're going to do winter wheat, you have to terminate that cover crop that was growing on that ground 35 days prior to seeding the winter wheat. To qualify for summer fallow for the next crop year, it'd have to be sprayed out by June 1st. That's basically impossible here for the most part. So if that was your intent, it's pretty hard to get that into a summer fallow category for the next crop. The other big thing is rotation restrictions apply to plants in the cover crops as well. So if you're going to put smooth peas in your cover crop, that then means that it's 2 years till you can seed monocrop peas on that field as well. So if you're putting peas and lentils and all this stuff in your cover crop, you're also limiting yourself on rotation going forward with those crops, basically. So So we're getting near the end here. So the biggest thing most of you guys want to know is what's going to happen with SCO and ECO payments. Real quick rehash on this, SCO and ECO both are county-based programs. So when the county gets below a certain level of revenue, if you're in revenue protection, it starts triggering payments over your whole farm on that crop. It's like buying into an ARC program, but a lot better coverage than ARC, basically. ECO insures you from the 86% level all the way up to 95%. And when it triggers, it'll pay you all the way up using your APHs on your farm all the way up to 95%. So if we had a bad drought year, what happens with this basically is if you're in ECO, SCO, and in revenue protection, and you start getting losses triggered on all of those things, you now have, as a whole on your farm covered up to 95% of what your average yield is, not just 75% like it would be if you just had the underlying revenue protection. So the other cool thing is if you're in SCO and ECO, and then you're in PLC, which you have to be in PLC at the FSA to be in SCO. You can't be in ARC and SCO together. When these things all start triggering, which was what was happening back in the early 2000s when this program came out, or like in 2014 plus, I guess, is we hit a drought. So we were getting SCO coverage at that point. There was no ECO, but we would get SCO plus we were getting PLC payments through the FSA. And so these were stacking on top of each other. And we can actually, in some of those years that PLC starts to pay too, get above 95% of our average guarantee on the farm by stacking the FSA program on top. If you're in ARC, you're restricted to not have SCO, and it makes huge differences in the payments. And if any of you guys have listened to my previous presentation stuff, if we get in that scenario where we're in droughts and all of these programs start triggering, you don't want to be in ARC at that point. So how did it pay through our agency? Because we've been in some pretty bad droughts here, it's paid a lot over time. So you can see the first year we offered ECO, it also started triggering those years. And so that was 21 and 22. You can see how much that added to these payments. But about $13 million in payout through our agency for, I think, I can't see it behind my head here, but about $4 million in premium. So large return on the money put into these programs during these tough years. What happened in 22, it triggered on most all the counties. I averaged our whole agency then for this. So paid out $48 an acre on average for everybody that was in ECO and SCO combined, and you paid $12 an acre in premium in there. So a 4 times at least payout compared to what you paid into it. The thing I'd always watch is what are the yields doing in the counties, because if a county yield gets too low on this program, it probably won't work anymore for that county. We've had some pretty bad years in Toole County, but luckily the RMA's kind of buffered these years. So we started at 38 bushels back in 2020 on this program. So in 2020 it was at 38 bushels an acre in Toole County. We've dropped off to about 36 here, but we've had some bad years in there. So luckily the yields when we've had these bad years aren't getting drugged down a lot. What I will tell you guys is I watch these pretty steadily, and if we have a big dump in yield, like let's say Toole County goes back to 30 bushels an acre, then we'll be sure to advise you guys that maybe this program doesn't make sense anymore. But for most of you guys, if you look at the yields they're reporting in your counties for these crops, I think you'll see they're very adequate, and that the program should function the way that it should. If you're in like Pend Oreille County, it to me is a no-brainer because your yields have increased because you had good years while we had bad years up north here. So you went from 46 bushels up to almost 50 bushels an acre for your county yield for wheat, in this dryland wheat in this example. It becomes incredibly easy to get paid in any kind of a drought blip in that scenario. So what's our data show for 23? Basically that in Glacier, Toole, Liberty Hill, and Pend Oreille counties, this is for wheat. And I also did barley in Toole County. You should get all of your SCO and ECO money out of all of those crops. The pulse crops are a little tougher because the prices went up on that crop and the yields were somewhat better. So through our agency, we're at about 81% of average for those crops. So you'd get all your ECO money out of the pulses and about half your SCO. But long story short, it worked again like it should. The prices dropped, which triggers payments more likely here too. So if you were in Hill County, if you were in yield protection on wheat, it would have come out at 86% of average for the yield in Hill County using the NASS data there. If you're in revenue protection because the market dropped, that'd get you down to 7% of the average. So that yield protection versus revenue protection, like in wheat and Hill County, is the difference between that paying or not there. So another reason to always be in RP on these programs. You guys have quotes sheets that you're going to look at in front of you there. One thing to check out here on this slide basically is that if you're in enterprise units with SCO, we can do that way cheaper than being in optional units with SCO. So right along that side there, we're at $11 an acre for that stacked versus 23 in optional in this example. Or instead of being in optional units on wheat, put it in enterprise units by type and use different wheat types at least to split your farm up. And then we can stack ECO, SCO, and your underlying insurance for less money per acre than just being in optional units with SCO, which is where most of our guys are at. And that functions so well if we hit droughts or market declines as far as buffering problems on your farm. So what are the odds this pays in 24? Anytime we're close to hitting a recession or get into a recession, the wheat market generally tanks. That's those gray bars in this futures chart here. The other thing is, because the wheat price has already come down quite a bit, it does make this program slightly less likely to pay because it's going to be harder for us to pull big drops out of it. But the premium is that much cheaper because the price is down as well. So I think there's a pretty good chance we're going to hit a recession. That's what this next chart shows us here. Back at our fall meeting, so if we go back to November-ish of 23, we were at about a 30 to 40% chance of hitting a recession on this chart. We're now up to about a 61% chance of a recession happening. The longer they leave interest rates up where they're at now, the higher the chance there is of that happening. And when that happens and the demand falls off for some of these commodities, we're already kind of seeing that happen in the wheat market, I think, because other countries are hitting recessions. But long story short, I think that's one factor that could drive these prices down, and probably drive that livestock market down too at the beginning on that LRP program. Soil moisture, like we talked, we're sitting in a little better spot than we were the previous year, so that's a positive, makes it a little less likely to pay. What isn't as positive is this is a long-term seasonal outlook through NOAA, I think it is here. And if you look at 23, they were predicting equal chances of being hot or dry in this, hot or cool in the summer, and then below normal precip, and this is for May, June, and July, which are pretty important months, right, for a growing season. In 24, now we're in a likely chance of having a hotter than normal summer, and we're in well deep into this below normal precipitation zone. So I always like to look at that. This seems to be reasonably accurate for what happens in general in our area. And if we're trending towards another drought and possibly steeper market declines, this ECO and SEO stuff becomes more and more likely to pay, which makes it another reason to be in it, right? Last slide, most important slide of the day, must use full legal signatures on all your documents. If we mail you something, don't just sign your name on there, put your entity name, by you, and what your title is in there. If we don't do that, the RMA is really sticky on that anymore. Don't wait to turn in a claim if you think you have one. Most of our problems that come from claims are that scenario. Don't let adjusters throw all your production together if you have records to separate them out. So even though you're in enterprise units, it's really good to keep all your optional unit structure the same in the background and keep yields by areas of your farm, because you might seed mustard once in a marginal area of your farm and it plugs a 0 in there for that, let's say. If we don't keep all of your units separate, it's going to take that 0 and combine it over your entire farm, where we'd like to keep that poor yield just down there on that poor spot, and maybe we never do that again. So strongly consider ECO and SEO at the current market conditions and drought conditions. Never take YP on a crop unless there's a very solid reason. The only reason you possibly would want to do that is if you had a feed barley contract and organic, let's say, we can then use your contract price to increase your price, or we couldn't in revenue protection. If you get a organic malt contract, we can put that on the malt endorsement and roll forward with that with revenue protection. Enterprise units by type makes putting wheat into enterprise units and peas way more appealing. And always elect PLC at the FSA unless you have a really good reason not to. There's more of a chance that ARC would pay this following year because the price has dropped some too. But there is huge differences in the potential payout on ARC versus SEO, which I would be glad to go with you guys individually someday if you want. So thank you so much for taking the time to listen to this. Hopefully you're still awake. And if you have any questions, just feel free to give us a call. And once again, thanks again.